It's Fed Day, where everyone is anxiously awaiting what the Federal Reserve will do with our interest rates. While another hike seemed like a foregone conclusion, that all changed last week when, by all appearances, our banking system blew up. Yes, I'm being dramatic, but you can't turn on the news or open a browser without seeing something about our banking crisis, leaving many of us asking, what happened? Are we really in a crisis? And what should we learn from this? Let's just start from the beginning. The Federal Reserve is the central bank of the U.S., and they have 5 key functions: conduct monetary policy, promote stability of the financial system, promote safety and soundness of financial institutions, foster payments through the system, and promote consumer protection. Everyone and their dog knows that the Fed has substantially raised interest rates in a relatively short time period. This is a tool of their monetary policy. The Fed uses it to maintain inflation and protect the value of our currency. What happened last week is the Fed's aggressive moves to contain inflation had a negative ripple effect on our banks. Here's how. You deposit money into banks for safekeeping. The Fed used to require banks hold roughly 10% of your deposits in reserve. It's a little bit more complicated than that, so I'm simplifying. The point is, in the case of a lot of withdrawals or a bank run, this was somewhat of a safeguard to make sure the money was there. Cue up March of 2020. In response to the pandemic, the Fed lowered that required reserve to essentially zero, meaning a bank could have 100 million in deposits and loan out 100 million. This is another tool in the Fed's monetary toolbox. By lowering the amount of money banks were required to have in reserve, the Fed provided more liquidity or more money for the banks to lend out to you and me. It's a way to push more money into the economy and prop us up during the pandemic. Let's look at SVB. SVB had about $130 billion in deposits at the end of last year. During their bank run, they had $42 billion withdrawn in one day. That's more than 30% of their deposits. They didn't have it in reserve, so they had to turn to their balance sheet for more money. From their perspective, the loans that they had made to others. The past few years, SVB made a lot of loans to tech companies, and that bet paid off. They made money hand over fist and invested a fair amount of it in the least risky asset, U.S. government bonds. Except these long-term safe holdings are very prone to one particular type of risk: interest rate risk. Sure, if they can hold the bond to maturity, they'll get their principal back. Except SVB couldn't do that. They needed the money back ASAP to cover the bank run, which means when they went to collect it back, they had to do so at a substantial loss, fire sale. Those U.S. government bonds, they aren't worth as much now because interest rates rose. No one was chomping at the bit to buy a 10-year bond paying 2% when money markets are paying 4%. Cue an immediate and substantial loss on the bank's balance sheet, which just fed panic and the bank run even more. Was SVB particularly exposed, and did they make bad, non-diversified investment decisions? Yes. Are they alone in this? No. The Fed's aggressive rate hikes have hurt anyone invested in longer-term safe government holdings, including banks, which is why the Fed jumped into action fast and announced a number of rescue measures hours after SVB's collapse. Should you be concerned? Depends on how you look at it. On one hand, we can take comfort that the Fed is going to great lengths to stabilize our banks. On the other hand, emergency action over a weekend can be a sign the Fed realizes they may have messed up big time. Which leads us to today. The Fed has conflicting goals. They need to control inflation, but they know continuing to increase interest rates will just put more pressure on banks. It is estimated U.S. banks are currently sitting on $620 billion in unrealized losses. Am I personally concerned about my bank deposits? Not really, but there are lessons to be learned in all of this. Retirees and investors, you can view your nest egg and your balance sheet like a bank's. The key to being successful is making sure your investments align with your time horizon. Sure, you have more control over withdrawals than a bank at the mercy of its customers, but you don't have total control. The key is to understand what your anticipated withdrawals will be every year, your retirement paycheck, and then build in a buffer for emergencies. The key is to not have to liquidate your investments when they are underwater, like SVB had to do. Even though they were safe, they had to sell assets at a discount. It's why retirees should have that middle bucket in retirement, the bucket that is not as susceptible to short-term market volatility and interest rate risk. Cash flow-based financial planning does exactly that. We map out what your expected cash needs are and then build an investment strategy that allows for long-term growth while providing stability for near-term distributions. Have you built your plan yet? That's it for this week. This is Jeannie, the 401k lady.